This is Greg for Teslafaninsight. Today's focus is stop loss or put when Tesla's stock price is up $15 or $500 or down $500. Any rate, we want to welcome you to the National Harbor. We're in Washington, D.C. Behind us we also have Air Force One, which is the giant plane you see sitting there. And we hope you enjoyed our show today. And we're trying to add a little flavor to the shooting area rather than the same location all the time. Any rate, today's show is concentrated on the fact that one of the questions we have gotten a lot in the last few weeks from different folks is, should I do a stop loss, or should I do a put in order to hedge my portfolio against some of the giant ups and downs we've seen recently from Tesla stock? So the answer can be very complex because of a number of variables. So we'll kind of start with stop losses. Basically what a stop loss is via your computer, you can tell the computer if, let's say, the stock right now is at 1500-ish. You can actually tell the computer, if the stock price suddenly begins to drop, I'd like to have you sell out my position so that I don't lose all of my money. So basically what happens then is that you have a situation where the computer automatically sells you out, and it puts a market order in to do so. So on one hand, you're in a great situation because you've set up the computer to automatically sell you out of your position. So it feels good, but the problem is that in a fast market, you'll find that all of a sudden the stock price will start falling dramatically. And as the price falls, you end up in a stuck position where you, in essence, have a market order in to sell. And in some of the situations we've seen from Tesla recently, we've actually seen a 100 to 200 point move in a relatively short 3 to 5 minutes, which is a real possibility post earnings for Tesla on Wednesday, the 22nd. So what we wanted to look at is, how should you manage yourself in a best case scenario in this situation? The answer that's coming up is that you need to be aware of a few things. In particular, one of the things that can happen is that when the computer is selling you out versus you doing it yourself, there's something called a bid and ask, and they'll give you the worst possible selling price or bid, whereas you could have chosen a better ask. A suggestion from what we saw in MarketWatch suggested a far better move was to go ahead and set it up so you get a price alert on the stock. So let's say the price alert is at 1500. Now you get an alert on your phone. You can whip out your app and then look for an exit point that gives you a better price on selling. So I actually think this is an excellent suggestion to try and optimize your gains rather than giving them all away as you sell out. So we wanted to encourage you to kind of think about this idea because it could become an issue. So why are we kind of looking at this? Well, it turns out if Tesla misses earnings, it's going to be down between 500 and 600 points the next morning. In fact, after hours, it's going to be down heavily. And if you have stop losses in, those will obviously hit the next morning. So it's going to be very tough to get out in an efficient way if things go south. Now, if things go north, that's a different deal. Now we have the stock up heading for 200-300 points, which is terrific. But you're still in a zone here where a stop loss makes sense because it's quite possible that it bounces up 200-300 points, pulls back, and then continues its run. So there are a lot of different scenarios of what could happen. But the bottom line here is that the stop loss looks like the most efficient, but it actually may not be. One of the other things we've seen going on recently is the hedge funds and their robots playing games with the stop losses. So the market makers can see the dollar value of your stock of your stop loss, And what they could actually do is force the price below that. The price of the stock will fall right after it hits, let's say 1500, back into maybe 1485. And then what will happen is, because they created that downdraft and they know it's artificial, they'll buy the stock there and watch it ride back up. And you've been stopped out of your position, and they're making a killing in the process. So this is another phenomenon associated with stop losses that I think is very challenging for small investors to consider as they're implementing. Another option to consider, well, the other thing to consider is, if you have a 401k or retirement, the fact that you were sold out of your position isn't that bad, because there aren't tax implications for your being sold out. For those who are not in that situation on their trading, there's also the issue of when you sell out, you generate a taxable event by that sellout. Hence why, if you want to hedge or insure in your portfolio, you really want to consider using options instead. The challenge though with options is that you do lose money on those options as the stock rises. So if you're buying puts to hedge your account, the value of those puts will decline very quickly as the stock price rises, which is the insurance scenario that you really want to consider. What I've noticed from a number of folks that I've sort of worked with on the trading side is that there are a lot of people who want the protection of the options on the downside, but they're also not happy with the money you lose down there. And so it's really just like an insurance policy. You're insuring your shares against loss, and there is going to be a loss on those shares, but how do you stay calm, embrace the insurance you have, and let it work for you as the stock price rises? On the flip side, when you have that insurance and the stock is falling, it's a really nice feeling to have the value of those options, the put options, rising in value if in fact the stock price drops dramatically. We've sort of played around with percentages to consider. Something in that 2 to 3% zone is if the stock falls 500, 600, 700 points, you're good situation. When you're dealing with a 10, 20% of your portfolio and put value against the calls you own, now you're talking the kind of stuff where if there's a 500 point drop, your account nets out at about zero. And now if you really push it and have puts to about 20%, 25% of the value of your portfolio, now that's a situation where you might even make some money if the stock price actually fell heavily. But the challenge is that's a lot to lose on the bottom end of that run. So I believe the decision-making process can actually be fairly challenging because of all the variables I just described. So, what would I recommend doing here? I think that Tesla will easily beat the number necessary as articulated by the number of vehicles they sold. But I would say that I really think this is kind of the Super Bowl of trading this year and what happens with Tesla on Wednesday. So I have to say that it's prudent to expect things to work out fine with Tesla, but not work out fine in terms of the powerful market makers and managers doing certain moves that result in people potentially losing a lot of money, even if they pick the stock to go in the right direction. So this is why you could also look at stop losses or notices or puts against your portfolio as a good idea, anticipatory of the fact that these guys may come up with something exotic for this special occasion that we've never heard of before or seen, and now you're scrambling to manage your funds accordingly while you're in that situation. So I would say that stop loss versus puts versus getting an alert so you can make that move. A lot of choices to be made there based on there's some variables associated with how you're structured in terms of how you're holding your shares. But I just think that it is going to be an amazing day. The other thing that I've been surprised by is the fact that between now and Wednesday, so basically until Wednesday morning when this happens, we've been subject to expert technique by the market makers and hedge funds in terms of how to force the stock price up and down and into places you wouldn't expect it to be, back down 50 points, etc. And one would think that there'll be a reduction in it closer we get to the announcement. But again, because there's nothing new that's changed even if there was an upgrade or something between now and earnings, I really think that we end up in a zone where the trading range of the stock is similar to what it's been until we finally get the announcement. The final note is we just did a show on the fact that it's a good idea to consider getting permission to do before and after market trading. The announcement will come half hour after market closes, and there's a trading period running from 4:30 until 8 p.m. So if you're approved for after hours trading, you'll be able to get in on the news and trade those shares against what's occurred with the stock. I think it's going to be very positive and up, but it could go a lot of different directions depending on how Tesla does with those earnings. So this is going to be a barn burner. I think it's going to be a once in a lifetime viewing of things that can happen as you see trading occurring. And I really think it's a situation where the best prepared will really win here. And I think it's just a matter of being aware of what your options are. As you go into the situation, you'll be able to choose the right direction relative to where everything is moving stock-wise. So basically, I wish all of you the best of luck in the process you go through this week.